Hello, everybody. Thank you all for being here today. It's such an honor for GMO to be able to present our best investment ideas to this group of elite allocators over the next 2 days. I'm Andy Finnegan. I'm on the client relations team, and recently I've worked closely with asset allocation and today's presenter, Dr. Martin Tarlie, on the development of a new and unique portfolio construction engine that we'll demo it here soon. But first, sequence of returns risk. Is it more bark or more bite? Martin is going to answer that question. Spoiler alert, it's not more bite. Martin's on the asset allocation team, and he has a variety of roles in research, portfolio management. He has background in both fundamental and quantitative equity analysis, a PhD and postdoc research fellow in theoretical physics, amongst other professional designations. Martin has been presenting the underlying science behind today's presentation since 2016 at major quantitative investment conferences. Just to name a few: Bernstein, Barclays, Credit Suisse. The responses he's received throughout were very consistent. His framework is unique and it's interesting. And with that, I'd like to give a warm welcome to Martin Tarlie.
Thanks all for attending this presentation. So I'm going to talk to you about sequence of returns risk. So people worry a lot about sequence of returns risk. How do I know? Because I get a lot of questions about it. So the more bark than bite, as Andy mentioned, is really related to this idea that it's not a different risk that you have to worry about. It's kind of embedded into the fabric of investing. So you don't have to do anything new or different. If you're already doing the right things, those will naturally handle sequence of return risk. So that's what I'm going to articulate as we go through the presentation. So in terms of an agenda, I'm going to start out with the motivation. Then we're going to go and we're going to look at some horse races. I'm then going to spend a few minutes outlining and articulating this new portfolio construction framework that Andy alluded to. And then I'll talk about where we're headed with this framework. So before we get into the details, I just want to kind of start with the main ideas, the main points, the main results of this research. The first is sequence of returns risk is not the same kind of risk that we're used to. When we invest in an asset, we worry about what fundamental risks those assets are exposed to. If we're investing in stocks, there's a depression risk, cash flow risk, etc. Bonds, it's more inflation-oriented risk. These are risks that you can alter by owning more or less of an asset. Sequence of returns risk really doesn't fall into that category. In part, it's only a risk if your portfolio, if you're withdrawing or contributing to your portfolio, and I'm going to illustrate that a little later. So from that perspective, it's really just a fact of life. But it's a real thing, and there are things that you can do to mitigate the impact of sequence of returns. The first is, how do you frame the investment problem that you're solving? What question are you asking? And it's really important to frame the problem that you're solving. Our portfolio construction framework is oriented around asking a very simple question. And that question is, what do you need and when is it that you need it? I'm going to come back to that later, but for now, just kind of hold on to that thought. So number one, frame the problem the right way. Number two, pay attention to the valuation of the assets that you're investing in. When assets are well positioned, when their expected return is high, own more of them. And when they're not well positioned, when their expected return is low, own less of them. There's a third issue that's raised by the sequence of return problem, and that is there's this essential tension between not wanting to lose money in the short run, yet compounding your wealth so that you have the assets that you need in the long run. None of us likes to lose money in the short run, and we tend to focus on that. But we have to balance the desire for not losing money with the need for having assets in the long run. And the sequence of return problem kind of really raises this particular issue. And a lot of what I'm going to talk about at the end is kind of oriented around having tools to help you understand the trade-off between the short-term desire not to lose money, yet balancing that with having the assets that you need when you need them. So let's start with the motivation for this problem. So the motivation for this problem is we have this new portfolio construction framework. We think it's a revolutionary portfolio construction framework. Hopefully by the end of this presentation, I will have persuaded you of that. The central idea behind this framework is that the primary investment risk that an investor faces is not having the assets that they need when they need them. Framed that way, that question naturally lends itself to the retirement problem. You're at a particular age, you expect to retire at a particular point in time, you have a certain longevity. So we've applied that framework to the post-retirement problem. When we go out and we talk to people about what the results of that framework are, we show a glide path as illustrated here. So on the vertical axis, we have the weight in various assets, and on the horizontal axis, we have age. So we assume, for example, that a person retires 65 years old. When they retire, when we apply our framework, the portfolio that they should own has about 60% of its weight in stocks. As that person ages, the weight in stocks falls. We find that very intuitive. Similarly, as they age, the weight in short-term bonds rises. So there is much that we find intuitive about this particular path of portfolios. We do get a question, however. 60% in stocks at retirement sounds like a lot. That's a common comment that we get when we show this particular glide path to people. So why do they say that? They say that because if you have a large weight of stocks in your portfolio at retirement and stocks do really badly, your portfolio is now in a hole. And it could be such a big hole that you're unable to get out of that hole. That's really the sequence of returns problem. So to get some more insight into why people have that intuition, let's just take a step back and look at some really simple examples and walk through how portfolios are sensitive to the sequence of return problem. So let's start with a really simple example where we don't have any cash flows. We start with $1 million, and let's imagine that we start out with a plus 25% return on our portfolio. So at the end of 1 year, we now have $1,250,000. Next period, we have a bad return. We go down 20%. So we go up 25%, we go down 20%, but we're back at $1 million. So that's a good return followed by a bad return. But what happens if the opposite happens? We start out with a bad return. So we start out with $1 million. It goes down 20% to $800,000. Next year, though, we get a big positive return. We get a 25% return, but we're back again to where we started. So what you see here is if there are no cash flows coming in or out of your portfolio, the order of returns does not matter. And that's simply a consequence of the arithmetic that 1.25 times 0.8 equals 0.8 times 1.25. The order of returns does not matter. But what happens if you're adding money to your portfolio? So now imagine that after year one, you add $50,000 to your portfolio. So let's start where let's first look at the case where you get a positive 25% return. In that case, you're at $1.25 million. You add $50,000 to that. You're now at $1.3 million, but then you get a minus 20% return. Now you're at $1,040,000. On the other hand, if you start with a bad return, you're now at $800,000. You contribute your same $50,000. You're at $850,000. You get a plus 25% return, and you get $1,062,500. So if you are contributing to your portfolio, you're better off getting a bad return and then a good return. But what happens if you're withdrawing? So this is the situation you would be if you're a retiree. Now, if you have a good return, so now you're at $1.25 million, you subtract $50,000, you have $1.2 million, and then you lose 20%, now you're at $960,000. On the other hand, if you start with a bad return, you have $1 million, you lose 20%, so you're at $800,000, you withdraw $50,000, you're now at $750,000, you then get your 25% return, you only have $937,500. This is why, this last example is why people worry about the sequence of returns when you're a retiree. So what do they do about it? What do people generally do about it? What they generally do about it is they reduce the equity weight. So this is a common glide path that you'll see out in the marketplace. And it has this particular shape in part to address the sequence of return problem. So what you notice is that the weight in stocks starts at 50%, it falls relatively quickly, and then it stays at a relatively low weight throughout retirement. So we have two competing views of the world. We have the common glide path, and we have our shortfall-based approach. So what can we do to assess whether or not which of these is more appropriate? To do that, we're going to run some horse races. And we're actually going to consider 3 horses, not 2. The first horse is going to be the common glide path that we just looked at. But in this case, we're just going to do stocks and bonds. And the reason why we're just doing stocks and bonds is because then we can use very long historical data set that starts in 1881. So we can do some historical back testing on this. The second horse is going to be our optimal shortfall approach. So this is very similar to the glide path that I showed you earlier. It has this kind of concave shape where your weight in stocks is approximately 60% and then falls as you age. Later, I'm going to explain to you the concepts underlying the optimal shortfall approach, but for now, if you could just bear with me on that. The third horse we're going to look at is built using the same framework as the optimal shortfall approach, but we're going to change our allocation to stocks and bonds based on how attractive they are. So in the optimal shortfall approach, we're not sensitive to valuations at all. You're just going to follow the path based on your age. But in the valuation-sensitive approach, we're going to use that same framework, but we're also going to incorporate the fact that expected returns can vary over time. So we're going to look at 2 kinds of races. The first is we're going to do historical backtests. And we're just going to use a standard valuation metric of price to trailing 10-year real earnings. The advantage of this historical backtest is we can start it in 1881. We're also going to do Monte Carlo simulations where we account for the mean reverting properties of assets. Turns out that it matters a lot how you model the assets, and I'll speak to that a little bit later on. So the first thing we can look at is, well, what's the probability that you run out of money? The probability of ruin, as people call it. These are the cases in our horse race analogy where the horses actually never finish the race. So what you see in the historical backtests, that if you withdraw at 5% per year, so what I mean by that is, imagine you have $1 million, and every year, no matter what's happened, you withdraw $50,000 a year. Okay? In the historical backtest, it's about 130 odd years of data that we have. If you withdraw at 5%, you ran out of money in roughly half of the cases if you follow the common glide path. If you follow our optimal shortfall approach, where you're not valuation sensitive, you basically cut that in half down to about 25%. And if you are valuation sensitive, you can cut that down by another third to about 18%. Now, if you run Monte Carlo simulations, the situation isn't quite as bad, although it's still bad. The numbers drop, but the basic pattern stays the same. If you follow the common glide path, you run out of money about 25% of the time. If you follow our optimal shortfall approach, it's about 15%. And if you're valuation sensitive on top of that, you can cut that even further to about 10%. Now, if you withdraw at 4%, obviously the probability of ruin, or the probability that the horse never finishes the rate, falls, but the basic pattern stays the same, is that the optimal shortfall is an improvement relative to the common glide path, and being valuation sensitive is an additional help as well. So going from the common glide path to the optimal shortfall results is really a consequence of framing the problem the right way. Asking the question, what do you need and when do you need it, and then solving that investment problem. The second move in going from optimal shortfall to the valuation sensitive approach is really a consequence of moving your assets. So asking the right question effectively cuts the probability of ruin in half, and moving your assets effectively cuts the probability by about another third. So those are the cases where the horses never actually finish the race. Let's now look at the cases where they get off to a really slow start. So these are bad outcomes, the lowest 10th percentile of outcomes. And let's look at 5 years into retirement. So if you're 5 years into retirement, what you see, if you squint really closely, is that the common glide path in these worst 10% of outcomes is slightly ahead of the optimal shortfall approach. So in some sense, this is validating the intuition that sequence of returns matters, and that one way to address that is to have a smaller weight in equities. The problem is the effect is really, really small. And as the race continues on, as you get to age 75, the optimal shortfall horse has overtaken the common glide path. And that pattern continues and extends. The optimal shortfall continues to outperform the common glide path, and the valuation sensitive approach continues even further. And what you see is that in these bad outcomes, the common glide path runs out of money approximately at around age 85. And when the others run out of money, they run out of money much later. So what about median outcomes? So these are the horse races where the speed of the horses is basically average or typical. What you see in these cases is that the common glide path is always behind. The optimal shortfall is ahead of the common glide path, and valuation sensitivity is always out in front. And when we run Monte Carlo simulations, we basically see the same effects, although the magnitudes of the numbers are a little different. So this basic idea, there is a small effect early into retirement where the common glide path is lower equity weight portfolio is ahead of the race, but that erodes relatively quickly. So that's for the bad outcomes, and these are the Monte Carlo simulations. So we basically see the same effect. So those are kind of aggregate, and we don't get a lot of intuition about what's actually happening. So let's look at a couple of examples where we can actually look at the dynamics of what's happening in the markets, et cetera. So it turns out retiring in 1970, well, the 1970s were not only bad for hair and fashion, they were also bad time to retire. So this is an example where you retire in 1970. And what I've plotted here is the cumulative real return on stocks starting in 1970. What you see is you get a big drawdown going into 1975. And you don't really make any real money until about 1982 or so. So this was a bad time to be a stock investor. If you thought bonds were going to be any help, you'd be mistaken. Turns out that the drawdown on bonds in real terms was as big as the drawdown in stocks. It was just drawn out over a much longer period of time. So that's why it was a really bad time to be a retiree. So let's look at our three horses. So the first, the common glide path and the optimal shortfall, we know what the path of stock weights is. It turns out that the valuation sensitivity, stocks were really cheap in the late 70s and early 80s, so you owned a lot of stocks at that time. And starting around 1990, they got to about fair value, and by the mid to late 90s, stocks were expensive, and so you didn't own a lot of stocks. So let's look at what happened to the different wealth profiles. So this is early into the race, the first 5 years. What you see is up until about 1973, there's not a lot of difference between the two because the return on stocks and bonds just really wasn't materially different. So your allocations really didn't matter that much. Where your allocations really mattered was when the market crashed in 1974. And what you see here is a big gap between the common glide path and the optimal shortfall in the valuation-sensitive approach, about $75,000 gap. But that closed relatively quickly. The valuation-sensitive approach basically caught up within a couple of years, and the optimal shortfall was not far behind. And if you look out over the course of the entire period, what you see is that the optimal shortfall continues to extend its lead over the common glide path, and the valuation approach extends its lead over the optimal shortfall. So in the common glide path, in this example, you run out of money at age 88. In the optimal shortfall, you run out of money about 3 or 4 years later. And in the valuation-sensitive approach, you never run out of money. And at age 88, in the optimal shortfall approach, you had about $125,000. And in the valuation-sensitive approach, you had over $300,000. So that's not a recent example. Most of us weren't around back then, or at least not investing back then. What about a more recent example? Now, we don't have 30 years, but we had a really bad market event, so it's still interesting to look at this example. So here I've plotted starting in 2008. So let's assume that we retired in 2008, and the market had a very large negative return, as we all know. So it had a very large negative return. Bonds actually provided relief, a little relief in this point. What you see is you see an uptick in 2008 and 2009. So there was some kind of hedging if you own bonds at that time. How did our horses do? So over a 10-year period, you see the optimal shortfall path. It doesn't really change much. The equity rate is really between 60 and 70%. But the common glide path starts at 50 and then falls to about 30. Now, according to the Shiller PE metric, stocks were expensive in 2008, so you only had about 10% in stocks in early 2008. But as markets fell, valuations got more attractive, and your weight in stocks rose to about 70%. Stocks got to basically fair value at the bottom of the market. And then the weight in stocks kind of continues to fall as markets rise and valuations rise. So not surprisingly, what you see when you look at the wealth of an investor invested in those three different portfolios, what you see early on is that the valuation-sensitive approach is ahead of the common glide path, and the common glide path is ahead of the optimal shortfall approach. So at the bottom of the market, the optimal shortfall approach is down about $100,000 relative to the common glide path. But what you see is that by the time you get into 2013, the optimal shortfall approach has basically caught up. And beyond that, it continues to extend its lead over the common glide path approach. What you also see is relatively recently that the optimal shortfall has actually overtaken the valuation-sensitive approach. That's because the valuation-sensitive approach is under-owning equities, and equities are really rallying in the face of a 10-year bull market. But in both cases, what you see is that either the standard optimal shortfall where you're not valuation sensitive or the valuation sensitive approach, you're about $200,000 ahead of where you would be if you were following the common glide path. So let's go back to kind of the main ideas. Hopefully I've persuaded you that sequence of returns is a fact of life, and whether or not you want a good return followed by a bad return or a bad return followed by a good return really depends on what you're doing with the cash flows. You can't control that, but there are things that you can do to affect the outcomes. These are the things that you should be doing anyway. Our advice to you to ask the right questions and to be valuation sensitive is independent of this sequence of returns issue. It's not something extra to worry about. It is a real effect. But what you can do about it is to ask the right question and move your assets. So I've talked about this portfolio construction framework, but I haven't told you what it is. So now let me just spend a few minutes sketching out some of the basic ideas that underlie this framework. So there are two main ideas. The first is frame the investment problem around a very simple definition of risk. The primary investment risk that you face is not having the assets that you need when you need it. And the second idea is that having less than you need matters a whole lot more than having more than you need. So these are the two underlying ideas. The heart of this framework is a new objective function. It's a mathematical formula that embeds both preferences of the asset owner and market views of the assets that you're going to own. Now, the preferences of the asset owner are, what is it that you need? How much do you care about falling short of that need? What do you have? And importantly, when is it that you need it? Now, when is it that you need it incorporates investment horizon into the problem. So horizon, the time period over which you're going to own these assets, comes really to the forefront in this framework. It comes front and center. What that means for your market views is that not only do you need to have a view on what expected returns are over next year, you need a view on expected return over the entire period. In addition to that, you don't only need to know about what the volatility of returns is next year. You also need an idea of the volatility term structure. Turns out that that matters a whole lot because the volatility term structure for stocks and bonds is very different as horizons change. That has a big impact on your portfolios. So this framework takes both the preferences of the asset owner, expressed in a very intuitive way, and the market views, which incorporate the investment horizon, puts that into this explicit objective function. We optimize that, and out comes a portfolio. Now, I want to emphasize that this objective function, we talk about expected shortfall. We have not just taken mean variance and replaced variance with shortfall. That is something that people actually do. We don't do it that way. We start with wealth, and we say shortfall is relative to a dollar value of wealth. And as horizon grows, that matters a lot because wealth is not normally distributed, it's log normally distributed. So the distribution of wealth becomes very skewed as time increases, as horizons increase. We focus on the left tail of that distribution, on being short of your target. That's the much more stable part of the distribution. So it's a very unique approach relative to kind of the standard conventional approach. It also means that horizon is very explicit in this framework, where it's not explicit in the standard mean variance approach. So just to kind of give a little visual picture of these two underlying concepts, this concept of what do you need. So on the vertical axis is how happy you are. On the horizontal axis is wealth. So this is kind of a standard Econ 101 utility function. Our framework allows for a wide array of potential utility functions, but the one that we tend to use the most is what we call the pure shortfall utility function. So if you are 20% below the target that you specify, you feel twice as much pain as if you're only 10% below the target. And if you're above target, you're equally happy. So this expresses this idea that falling short of your target matters a whole lot more than being above the target. This does not mean that you don't care about the return of your portfolio, but the return of your portfolio is embedded into your target. If you have $1 today and you want $1.10 next year, that implies a return. If you change that wealth target, that changes the return. So to give you a better sense of kind of what this framework is and what it isn't, it's useful to go back to kind of the conventional approach and look at a standard efficient frontier. Here I've plotted a standard efficient frontier for just stocks and bonds. And if you were following the standard mean variance approach, what you would do is you would specify a risk aversion coefficient. And if you specified a risk aversion coefficient in this example of 4.3, you would be on the lower left-hand portion of the efficient frontier. And as you become less risk averse, you move up and to the right along the frontier. Now, the problem with this approach is, and practitioners recognize this, is what is the appropriate risk aversion coefficient for an asset owner? We don't really know. We know what people have. We have an idea about what they might need in the future. We know how long they have to compound their wealth. So those are the things that really matter, and practitioners recognize this. So we ask asset owners a bunch of questions, and then what we do is we map all of those answers and we boil them back down into this risk aversion coefficient. This risk aversion coefficient becomes a catch-all for a whole array of things that matter to the asset owner. What I showed you before is the inputs into our objective function. What do you need? When do you need it? How much do you care about falling short? Those are already naturally embedded into our approach. So to illustrate that, if we determine that the asset owner has a 5-year horizon and wants to compound their wealth at 5%, it turns out that they will be on that portion of the efficient frontier that corresponds to a risk aversion coefficient of 4.3. But what's more intuitive? Asking them what their risk aversion coefficient is, or understanding that the primary question is, what do you need and when do you need it? Want to compound at 5%? And I have a 5-year investment horizon. Now, if we hold the target compounding rate fixed, and we increase the investment horizon, we move up and to the right along the frontier. That's very intuitive. A 15-year horizon, turns out that that corresponds to a risk aversion coefficient of 2.5. As we increase the horizon further, we continue to move up and to the right. So what this is illustrating is there's no magic here. It's not like we found a new efficient frontier that's moved you out and it's a better kind of return to volatility characteristics. No, we're just telling you where on the frontier you should be based on framing the question the right way. What do you need and when do you need it? Now, one last point. Some people might say, well, in this example, you've said you want to compound your wealth at 5%. So why don't you just pick the expected arithmetic return, in this case it turns out to be about 5.5%, that corresponds to compounding at 5%. And why don't you just pick that portfolio on the efficient frontier? That's only the right portfolio if you have a 10-year horizon. If your horizon is longer, you should be further out. You'll do better. If you have a shorter horizon, you should be on the lower left of that point. Okay, so where are we headed? Why are we doing this? Where are we going? And how can we possibly help our clients? So one of the ways that we can do that, as I mentioned earlier, there's this essential tension between not wanting to lose money in the short run, and so a natural reaction is we'll just own less of the assets that can go down a lot in the short run, versus this, I need money in the long run because I have to consume that. So we built a tool that's still in its very early stages to help you understand the trade-off between losing money in the short term and compounding your wealth in the long term. So I'm going to come back to that. I'm going to give you an example in a moment. So what we're doing is we're building a platform that expresses this portfolio construction framework. It combines these ideas that I outlined with our world-class asset allocation. The combination of this portfolio construction engine with our asset allocation insights is going to lead to better outcomes, in expectation, of course. So what is unique about this? Well, one of the things that we think is unique about this are the main concepts that are underlying how we're thinking about risk in this framework. What do you need and when do you need it? An investment horizon matters. It's a first order effect. This idea of asymmetric preferences is not new, but the way that we've employed it and our focus on the left tail of the wealth distribution, we think is a unique way to do it. But at the heart of this is this new portfolio construction engine that has this new objective function that embodies the main concepts. So we think of this as needs-based optimization in contrast to mean variance optimization. The benefits of this are clear. Better outcome than expectation. We focus on the outcome, not on the volatility of the portfolio. We think it's intuitive and easy to understand, and importantly, it's something that we can actually customize both to the asset owner and to somebody who's advising the asset owner as well. So the platform that we're envisioning has two primary components to it. There's an advisor-facing tool. So we would customize a glide path down to the level of the individual. That glide path then actually becomes the benchmark for active management around that glide path. This idea actually came out of discussions that we had with Rich and his partner. Rich is sitting right there. And it's very intuitive, and I'm actually going to give you a demonstration of where we are in terms of the prototyping of that. But one of the nice features of this approach is it helps you illustrate the trade-offs between this short-term desire not to lose money, but the fact that you need to actually compound your wealth over time to have the assets that you need. So that's kind of one side of it. The other side of it is we're building a tool for kind of CIOs and portfolio managers to create customized model portfolios that would be private to that CIO or portfolio manager. We envision this as being entirely open architecture where fulfillment could proceed using any array of possibilities. It would not be tied to GMO fulfillment. So we think of this tool as kind of enhancing the CIO versus outsourcing the CIO. Now, one of the key things that we think this platform will embed is our insights into return, risk, and investment horizon. Now, those insights get employed into our optimization framework, but one of the other things that when we go out and we speak to people, we hear a lot about is, well, we use Monte Carlo. Monte Carlo can be an extremely valuable tool, but what matters in Monte Carlo is what's underneath the hood. What are the models that are driving your simulations? That matters an enormous amount. We think we have insights into how to model, especially over longer horizons, that has tremendous impact on the portfolios that you would own. So with that, I'm going to see if I can get the technology to work. And we have our technology expert if I fail epically. Whoops. Did I mess something up? There we go. Beautiful. Okay. How many? Okay. So what I'd like to do now is give you a flavor for the types of things that we're actually constructing. And this, as I said before, came out of conversations with Rich and his partner. So what we're seeing here is a component of the advisor-facing part of the platform. So what you see up on the top panel, so this is a tool designed to help you figure out a glide path customized to an individual. So what you see in the top panel is the age of the individual is 45. They expect to retire at age 65, and they expect to live to age 95. Their current wealth, $250,000. Their target at retirement is $1 million, and they want to leave $500,000. Made some standard assumptions about how much they're going to save and how much they expect to spend in retirement. The combination of those things, that really embodies this question of what do you need and when do you need it? there are target compounding rates associated with those levels of wealth and the cash flows. So if you do an internal rate of return analysis on those levels of wealth and cash flows, what you come out with is a target compounding rate in the pre-retirement of 4.9% and in post-retirement 2.9%. So I'm just going to round those to 5 and 3. If we then take that and we optimize and find the optimal portfolio, what you see is in the top panel here. So you see a portfolio that is 100% in stocks at age 45. It falls to about 70% at retirement, continues to fall in there, and the weight in short-term bonds rises. Now, that might be way too much stocks at first sight for an individual who's 45. They might say, listen, I don't think I can stomach the volatility that's tied to that level of stocks at age 85. So what we can do is we can go here and we can compare to another portfolio. So I just went in and I changed the target compounding rates, but you'll be able to put in things like put a maximum weight in stocks, et cetera, et cetera. The idea that we have here, it's kind of like going to the eye doctor. You go to the eye doctor and they have you look through a bunch of lenses and they say, which looks right to you? So that's really what we're trying to do here. What looks right to you? So the optimal is in the top panel. An alternative is in the bottom panel. So now what we can do, as I mentioned before, we can run Monte Carlo simulations. So what we're going to say here is we're going to basically put in the same parameters that we had before, but what we're going to say is that whatever our wealth is at retirement, we're going to withdraw 4% of whatever that number is at a constant rate going out. So if we had $1 million at retirement, we'll withdraw $40,000 a year, and it'll increase at inflation. If we had $2 million, we'd withdraw $80,000 a year. So let's run, so the danger of doing real-life test, let's run the Monte Carlo simulation and see what happens. So in this top panel, what we see is the first line is this is what we're optimizing over. This is our expected shortfall number. The closer to zero, the better. Minus $70,000 is better than minus $140,000. This is the average shortfall relative to your target over your entire retirement years. But the numbers get more important and more intuitive as you go down. The average median wealth in retirement, if you follow the top glide path, is $1.3 million. If you follow the bottom glide path, it's $750,000. And what you can see in the graph here are these median numbers. So the blue circles are the medians for wealth following the top glide path, and the red are the medians if you follow the bottom glide path. And what you can see is there's a difference between those, a big difference. If you're withdrawing at 4% using the top glide path, your average withdrawal per year in retirement is $55,000 versus about $38,000 in the other approach. So you're way better off on average throughout retirement. This doesn't come for free, though. And this is where we come back to short-term losses. The worst 1% of outcomes after your first year, if you follow the top glide path, is minus $63,000. If you follow the bottom glide path, it's about half that, $36,000. And the volatility is obviously a lot higher because you own 100% stocks. So what's the right answer? There is no right answer. People have to understand the trade-offs that they're facing, and they have to come to some conclusion about what the trade-offs are. This is a tool to help illustrate, starting with what's optimal from an expected shortfall perspective, but that may not be appropriate for everybody. So this gives you hopefully some sense of where we're headed with this. This is one component of what we envision as being a much broader platform. And with that, I'll end it and take questions.